On today's episode, we're going to take a look at Microsoft's financial numbers and see how they're doing compared to previous quarters. Let's take a look. Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment, would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. So like mentioned, this is going to be part 2 of Microsoft. We did part 1 yesterday where we took a look at the actual information they posted on their press release for Q3 earnings report, and then we took a look at their earnings transcript. So if you guys want to look more in detail about the company, I suggest taking a look at episode 1. If not, let's begin here with episode 2. We're going to look at their financial numbers and determine if I was and finally make my decision if I would buy or pass on Microsoft. Like always, I'm going to use this amazing website known as LazyFA, which allows me to see all these financial sheets in an awesome format, graphical format, so I can make these episodes go pretty fast and provide you guys with so much information in so little bit of time. So we're going to take a look at the income statement, balance sheet, cash flow statement, and then we're going to take a look at some of the stuff that LazyFA shows us to make sure that we're looking at the right information. So here we are in the income statement. We can see revenue, right? Revenue is killing it. We are seeing this uptrend in revenue, even though revenue itself in this quarter is lower than last quarter itself, right? Quarter of 2000 ending March 2019 is lower than quarter ending in December. But like I said, the overall trend as Microsoft revenue is still up, and that's definitely a good thing. One thing, right, we're taking a look at Q3. If you guys didn't know, we're taking a look at quarter 3 of Microsoft. So we're only going to be looking at quarter information. We're not going to take a look at annual information. We'll wait for Q4 to take a look at annual information. Next, after we look at revenue, right, we can take a look here at cost of revenue. We can see cost of revenue. It seems that quarters 2 seems to always have a higher jump than previous quarter. We can see here, quarter 2 this past year was almost $12.444 billion. Quarter 2 of last year of 2017 was 11.6, and so on. But here we can see, right, this major jump up in every quarter 2 of every year. So last year was no different. Last quarter was no different. It was the highest compared to previous quarters. But we can see cost of revenue itself is increasing time and time again. Gross profit, right, which is the difference between our revenue and cost of revenue, right? So this is how much profit they're keeping after all the expenses that they needed to make sales. Right, there's other types of things, and we'll take a look at net income. But here we can see their gross profit is pretty high. It seems to have decent margins, right? We can see here they had right now they have $20 billion of gross profit. So about 66%, we'll take a look in a bit, but about 66% of gross profit margins. Earnings before income tax, the only reason I take a look at this is to see if there's any difference between the way the shape looks here in earnings before income tax and net income. If they have different shapes, it means that they either are paying some extra taxes or something is going on there. But here we can see the past few quarters, everything looks pretty similar, so it's nothing out of the ordinary for us. Net income is standing right now at 8.81 billion. I think it's pretty high up there compared to previous quarters. There's only 2 quarters that are a little higher than that, and that was 2018 ending in June. They had 8.87 billion, and then the previous quarter after that. So Q1 and Q4 were a little higher, but not by much. I want to say by $0.05 billion. So here we can see in our income statement sheet, company overall is doing really great. This company is on an uptrend in revenue, gross profit, and so next we'll take a look at LazyFA. It gives us, we're taking a look at their income sheet, and it's just pretty much what we just saw, but in a different format. Here we get to really see that gap between revenue and cost of revenue and how big that gap is, and that's why we have such a positive gross profit. Next, we have percentage-wise of revenue growth versus cost of revenue growth, and we can see there's nothing abnormal here going on throughout the quarters. So again, this is something where I try to look for some abnormality to make sure nothing fishy is going on, and everything at the moment seems to be going pretty good. Here are my favorite margins we want to take a look at. Gross margin is 66%, right? Just like I mentioned earlier before. But this company as a whole does have a nice profit margin of almost 30%. They're keeping about 28% of its total revenue. That's definitely a high number to keep. Definitely companies have. It's good to see such a high value for that. And we can see, right, it's around the park where it's normally at. We see some 27, some 30s. So 28.8 seems to be the medium around the most recent quarters. So that's definitely good to know that, again, there's no huge fluctuations that might deter me from this company showing some fishy business. Next, we're going to take a look at red flags that Lazy FA shows us. And here, this red flag is just telling us that on average, cost of revenue is growing at a faster rate than revenue itself. But we can see here, right, by our revenue versus cost of revenue, it doesn't matter how much cost of revenue is growing percentage-wise. This gap is so big at the moment that it doesn't really affect it. So thank you, Lazy FA, for giving me that red flag. But it's not something I want to take. I am very I'm not focused on. Next, we'll take a look at the balance sheet. Here in the balance sheet, we take a look. This to me is one of my favorite sheets. We get to see what the company really is with total assets, total liabilities, total debt, receivables, payables, and cash equivalent. So here we can see this company total assets. Again, we have that uptrend going on. This company is increasing its assets over the quarters. Unfortunately, its total liabilities are also increasing, but we can see it's almost to like a 1.5 to 1 ratio. Right now, assets are about 260 billion, where total liabilities are 168 billion dollars. So we can see there is definitely a huge gap between the two. So, but unfortunately, we can see liabilities increase at a higher, faster rate compared to total assets, where total assets seems to be a more linear rate. Here we have this parabolic increase going on, but it does seem to be flattening out up top right now. Total debt, we can see this company is paying off huge amounts of total debt. It peaked in December of 2017 at almost $95 billion. And right now we're sitting at about $80 billion of total debt. And we can see that huge drop, and I'm hoping this company continues to pay it down. The receivables, again, this is money they are expecting to come in, and they have about 19 billions of receivables, when they have payables of only about $7.5 billion. So payables are what they owe their suppliers or any other type of their business partners. How much money they owe, how much money they paid throughout this quarter, or have some debit on. I always like to put these two against each other. It's good to see that they are collecting more money than they are sending out in payables. Cash and cash equivalents. This to me is pretty impressive. Such a huge percentage of the assets, of the total assets, are cash and cash equivalents. I definitely want to take a look at this later to see what the actual numbers are of how much cash this company has. But look, this company has about $131 billion of cash and cash equivalents. So that alone is definitely giving me good vibes for this company. This company is not going to go out of business anytime soon, if any at all. So here we can see our assets versus liability in that same graph, similar as we saw the revenue and cost of revenue. We can see here assets are pretty high. But now here we take a look at the shareholder equity. The shareholder equity is pretty much what the shareholder owns, right? Is our difference between total assets and total liabilities. So once we have subtract that, it's how much the company is truly worth. And we can see, right, over time, right now we're sitting at about $95 billion of shareholder equity. But unfortunately, this is where it was sitting at about 5 years ago. That's to me is a little scary, right? Shareholder equity as a whole hasn't increased. It decreased over time and now it's re-increased. I just want to take a look at, we can see I'm pretty sure a huge amount of that is because of the total debt this company took in. So once we start reducing this total liabilities, we'll be able to have that shareholder increase and over time. Hopefully this company does not have any plans of taking on more debt. Here we take a look at assets versus liability growth. Again, nothing seems abnormal to me. I just want to take a look to make sure there's no abnormality going on there. Now this is one of my favorite things from Lazy FA. We get to see asset distribution and liability distribution shown in a perfect pie chart. We can see right cash and cash equivalents are 53% of a company's total assets. Personally, I think through my whole time of taking a look at companies, I have not seen a company. I don't think I've done Apple. Maybe if I do Apple, it might be, but I have not seen many companies that say 53% of their total assets are cash and cash equivalents. So again, that's definitely a huge number. And the other thing that I like about this is its total inventory, which is less than 1% of its total assets. This company has a lot of products, right? They have a lot of computers, they have a lot of laptops, they have a lot of software. It's pretty impressive that less than 1% of their total assets. That means this company is not overstocking anything. Again, that's definitely good news. Fortunately, here we can see a huge percentage of this liability is non-current debt. Here it's sitting at about $62.5 billion, sitting at almost 50% of its total liability. And this is definitely a scary note to see, but this company has plenty of cash and cash equivalents to pay off its total debt and current debt. And the other thing I like to see is this company does have deferred revenue. For those that don't know, deferred revenue is they have deferred revenue is when a company has some kind of contract where they need to provide or sell X amount of products to this company, and in return, the company paid Microsoft already ahead of time. Microsoft already has the money ahead of time, but they have yet to deliver these products. So until they really deliver this product, this cash that they collected is actually a liability, right? Because what happens if they don't deliver these products? They might have to pay some extra fine and more money compared to the revenue that came in. So until Microsoft pays off, delivers their product, or however the contract worked, this deferred revenue will be a liability. Eventually, it will become an asset. So again, this is good, in my opinion, good news. There's nothing else I want to take a look here in liability distribution, except right, we are paying off that non-debt. Finally, the last thing I want to take a look at is net cash flow from operations. There's different types of net cash flow from the cash flow statement, but this is the only one I care about, right? Cash flow from operations means that this company is either making or losing money from its everyday use. And as a company, your everyday operation should be bread maker. And as it is here, we can see this company is negative cash flow positive of $13.52 billion. Again, this company, like I've mentioned in episode 1, part 1, we saw how this company is investing heavily on growth. And at the same time, this company is at such a stable place that to me, this is not a no-brainer. If I was looking for another investment, I would definitely buy Microsoft. This is actually one of my favorite stocks that I've seen. It's one of the healthiest charts I've seen in a long time. And for that, I am definitely looking into buying to Microsoft. I want to know what you guys thought about Microsoft. Would you guys buy? Are you guys long? Are you guys short on Microsoft? And please explain why. Post in the comments below so I get to reply to you guys and get to understand other people's thoughts. Hope you guys enjoyed the episodes. Don't forget to subscribe to make sure you get updates and on these videos and all the other video series I do. So take care, guys. See you next time and have a good night.